Look, I need to be straight with you about something before we dive in. It's Sunday evening here and I'm staring at my screens, and what I'm seeing out of Shanghai is not normal. I've been analyzing commodity markets for 12 years now. Built my first silver position back when spot was still hovering around $28, and I've never broadcast through one of these AI avatars before. But here's the thing. I'm tired of waiting half a day for Bloomberg or Reuters to report what is already happening in real time. And frankly, I'm tired of watching all these new AI channels pump out recycled hype and clickbait about silver without any actual data behind it. So I built this channel to get the real information out fast to people who actually understand what's at stake here. Because right now, while most of North America is wrapping up their weekend, there's a very quiet crisis unfolding in the Shanghai Gold Exchange vaults, and almost nobody is talking about it. Here's what I'm looking at. It's January 11th, 2026. It's Sunday evening Eastern Time. The Asian electronic markets have been open for a few hours now, and silver is absolutely ripping. We're talking about XEG USD sitting at 79.88 bid, $802 ask. That's a 4.21% vertical move in a single session. But here's what they're not telling you on CNBC. Here's what you won't read in the Wall Street Journal tomorrow morning. That price you're seeing on your screen, it's increasingly becoming a fiction, a suggestion, a polite lie that everyone has agreed to maintain because the alternative is too scary to acknowledge. The physical metal isn't moving. I want you to understand something. January 1st, 2026, 11 days ago, China effectively built a wall around their silver supply. New export licensing requirements, new restrictions, new rules that sound bureaucratic and boring until you realize what they actually mean. China just ring-fenced the world's largest source of refined silver, and now the downstream effects are starting to cascade through the system. The Shanghai Gold Exchange, which handles more physical silver delivery than any other venue on Earth, is reportedly failing to fulfill delivery requests. Not delaying them, not processing them slowly, failing to deliver the metal. And the mainstream narrative, the big banks are telling you this is just silver finding its range after a volatile December. They want you to believe the liquidity is fine, that this is just normal price discovery, that there's nothing to see here. But I've got the vault reports pulled up on my terminal right now, and the inventory numbers are screaming something very different. We're going to break this down piece by piece. And by the end of this video, you're going to understand exactly why the next 72 hours might be the most critical period in the silver market in decades. Here's my promise to you. I'm going to walk you through the force major mechanism that exchanges use when they can't deliver physical metal. I'm going to run the actual math on the 17-ton inventory drain that happened on January 9th. I'm going to show you the spread between paper price and physical reality. And then I'm going to tell you exactly what I'm doing with my own capital over the next few days. Not advice, just transparency, because if you think your paper silver position is the same thing as a 1,000-ounce bar sitting in a vault with your name on it, you're about to learn a very expensive lesson. Let me lay out the core thesis here because this isn't complicated, but it is urgent. The Shanghai Gold Exchange is the world's most important physical silver market. When industrial buyers need silver, and I mean actual silver, not contracts, not derivatives, but the real metal to build solar panels and electric vehicle components, they go through the SGE. And right now, that system is breaking down. We're not talking about a delay or a logistical hiccup. We're talking about a systemic failure of the physical delivery mechanism. Industrial giants are standing for delivery, meaning they're saying, I don't want the cash equivalent. I want the actual metal, and the vaults are coming up short. Here's why this matters so much. Silver isn't like gold. Gold sits in vaults and looks pretty and holds value. Silver gets used. Every solar panel requires about 20 grams of silver. Every electric vehicle uses between 25 and 50 green, depending on the model. The entire global energy transition that every government is pushing, every ESG fund is investing in, every manufacturer is pivoting toward, all of that runs on physical silver. And if the primary delivery hub in the world's largest manufacturing economy can't deliver the metal, we have a problem that goes way beyond commodity traders making or losing money. We have a problem that threatens industrial supply chains. The conflict here is straightforward. China needs every ounce of silver they can get their hands on to meet their domestic industrial demand. They are building solar capacity at a scale that is hard to even comprehend. They installed more solar in 2025 than the entire rest of the world combined. Meanwhile, they're also the world's largest producer of electric vehicles. So on January 1st, they implemented these new export licensing requirements, and the message was clear. Silver produced in China stays in China. Silver refined in China stays in China. And if you want to get metal out, you better have a really good reason and a lot of paperwork. 11 days later, the Shanghai Gold Exchange is dealing with the consequences of that policy. And those consequences are showing up in the vault reports. Let me give you the current market snapshot, because the data here tells a story that the price action alone doesn't capture. A few hours ago, I was looking at the opening in Asia, and silver was sitting at 79.88 bid, 802 ask. Now that 14-cent spread might not sound like much, but in normal market conditions, that spread is typically 5 to 7 cents. When you see a spread that wide, it's telling you something. There aren't enough sellers, liquidity is drying up. People who own physical metal are getting increasingly reluctant to let it go at these prices because they're not confident they can replace it. And then there's the price action itself, up 4.21% in a single session. And this isn't some gradual climb, this is a vertical rip. We tested the $80 psychological level, pulled back about 12 cents, and now we're grinding right back up toward it. $80 is significant because it's a round number, and round numbers create psychological resistance. Traders put their stops there, algorithms trigger there, it's a line in the sand. But more importantly, look at what happened in December. We hit $84. That was the recent high. And then we pulled back. So $80 right now is also the halfway point to reclaiming that December high. If we break through 80 convincingly and hold it, 84 becomes the next target, and there's not a lot of resistance between here and there. But I want you to stop focusing on the price for a second and look at what's happening in the physical market, because that's where the real story is. According to the vault reports I'm seeing from CIC and the Shanghai Gold Exchange data, 17.3 tons of silver vanished from SGE warehouses on January 9th alone. 17.3 tons in one day. Now, some of that is normal withdrawal for delivery to industrial users. That's how the system is supposed to work. Metal comes in, metal goes out. The exchange acts as the intermediary, but the velocity of these withdrawals is accelerating. And more importantly, the replenishment isn't keeping pace. Let me put this in context. The SGE's total stockpile, according to the most recent figures I have access to, is approximately 620 tons. If we're draining 17.3 tons per day, and let's be conservative and say that's not every day, but just the high stress days, you're still looking at a runway that's measured in weeks, not months. Even if the average daily drain is half that, let's say 8 or 9 tons, you're still looking at a couple of months max before you hit absolute zero. And that's assuming no acceleration in demand, no panic buying, no industrial hoarding, all of which, by the way, are probably happening right now. And then there's the margin hike. On January 5th, the SGE increased margin requirements to 20%. Let me explain why that's a flashing red alarm. Exchanges don't hike margins because they're bored. They hike margins when they're worried about counterparty risk, when they're worried about default, when they're worried that the volatility is about to spike and people won't be able to meet their obligations. A 20% margin requirement means if you're holding a leveraged position and the price moves against you by just 5%, you're underwater. You get a margin call, you either post more cash or your position gets liquidated. So ask yourself, if this was just a paperwork problem, if this was just a bureaucratic backlog from the new licensing requirements, why would the exchange feel the need to de-risk the system so aggressively? Paperwork doesn't cause margin hikes. Systemic stress causes margin hikes. Now let's talk about force majeure, because this is the mechanism that everyone needs to understand. And it's the reason I titled this video the way I did. Force majeure is a legal term that shows up in contracts, and it essentially means act of God or unforeseeable circumstances. It's the escape hatch. It's the clause that allows one party to a contract to say, look, I know I promised to deliver X, but something happened that was beyond my control, and therefore I'm excused from performance. In the context of commodity exchanges, force majeure allows the exchange to convert physical delivery contracts into cash-settled contracts. You thought you were getting silver bars. Instead, you get a check. Here's the thing about force majeure. It's technically legal. It's in the rule book. Every exchange has provisions for it, but just because it's legal doesn't mean it's not a default. It absolutely is a default. You entered into a contract to receive physical metal. You paid for physical metal. You planned around receiving physical metal, and now you're being told, sorry, plans changed. Here's cash instead. That might keep the exchange from being sued into oblivion, but it doesn't solve your problem if you're an industrial buyer who needs that silver to keep your production line running. Let me give you an analogy, and I promise this is the only time I'm going to use food as a metaphor, but it works. Imagine you order a pizza. You pay for the pizza. You're hungry. You've got friends coming over. You're counting on this pizza. The delivery driver shows up at your door, but instead of handing you a pizza, he hands you a $20 bill and says, sorry, we ran out of dough. Here's your money back. Technically, you're made whole in dollar terms. You paid $20, you got $20 back. But you're not actually made whole because you can't eat a $20 bill and your friends are still hungry and the whole plan for the evening just fell apart. Now, Scale that up to industrial manufacturers. A solar panel company in Germany has a contract to receive 2 tons of silver from the SGE. They need that silver to meet their production targets. They've already sold the panels to customers based on the assumption that the silver will arrive. And then the SGE says, force measure, here's the cash equivalent. Great, except you can't build solar panels with cash. You need the actual metal. And if you try to go buy that silver somewhere else, you might find that the price has moved significantly, or that there's no available supply, or that the premiums over spot are astronomical. So you're stuck. Production stops. Contracts with your customers get delayed. Revenue takes a hit, all because the exchange decided to hit the reset button. And here's the darker possibility that I want you to consider. What if this isn't just a supply problem? What if this is strategic? What if China looked at their domestic industrial needs, looked at their available silver supply, and made a calculated decision that foreign buyers are going to be the ones who get cut off first? I'm not saying that's definitely what's happening, but it fits the pattern. January 1st, new export restrictions. January 5th, margin hikes. January 9th, 17-ton inventory drain. January 11th, rumors of delivery failures. This doesn't look like a system under accidental stress. This looks like a system being deliberately restructured. Now, let me walk you through the math here, because I think once you see the numbers laid out, the severity of the situation becomes impossible to ignore. We'll start with the conservative scenario, the one where we take the official numbers at face value and assume everything is mostly normal, except for a bit of extra stress. The Shanghai Gold Exchange has approximately 620 tons of silver in inventory right now. That's the number I'm seeing from the most recent vault reports. On January 9th, they drained 17.3 tons in a single day. Now, let's assume that was an unusually high day. Let's say the average daily drain is more like 10 tons. That's probably generous, but let's use it as a baseline. 620 tons divided by 10 tons per day equals 62 days, 2 months. That's your runway before the SGE hits absolute zero inventory, assuming no increase in withdrawal velocity and no decrease in replenishment. But here's the problem. We have every reason to expect withdrawal velocity to increase. As word spreads that the SGE might not be able to fulfill deliveries, what do you think industrial buyers are going to do? They're going to panic. They're going to stand for delivery now while they still can. They're going to pull their metal out of the system and hold it themselves rather than trusting that it'll be there when they need it later. That's basic game theory. Everyone has an incentive to defect, to grab their share before the pool runs dry. And on the replenishment side, where's the new supply going to come from? China isn't going to ease those export restrictions. If anything, they're probably going to tighten them. Silver miners in China are going to be under pressure to sell domestically first. Refineries are going to prioritize domestic customers. The flow of metal into the SGE vaults is going to slow down precisely when the flow out is speeding up. That's a recipe for a death spiral. Now let's talk about the stress test scenario, because there's a rumor circulating. And I want to be clear that this is unconfirmed, but it's coming from sources in Tokyo that I consider credible, that there was a recent delivery failure that is much worse than anyone is publicly acknowledging. The rumor is that an industrial buyer requested 64 tons of silver from the SGE and they received 1 ton. 1 ton out of 64. That's a 1.5% fulfillment rate. If that's true, we're not talking about a supply squeeze anymore. We're talking about a complete breakdown of the delivery mechanism. And before you dismiss this as too extreme to be possible, let me ask you, what would be the incentive for the SGE to publicly admit to that kind of failure? There isn't one. The incentive is to keep things as quiet as possible, to try to manage the situation behind closed doors, to hope that they can stretch out the inventory long enough for new supply to arrive, or for demand to cool off, or for anything to change the dynamics. But here's what they can't hide. The price. If there's really a 1.5% fulfillment rate, that's going to show up in the physical premiums, and it is. I've been hearing reports of silver trading in Tokyo with premiums of $50 over spot. $50. That would put the real physical price at $130 per ounce, while the paper price in New York is sitting at $80. That's a 62% premium. That doesn't happen unless there's a genuine shortage of physical metal. Now, I can't confirm the 1 ton out of 64 story. I'm not in the room where those negotiations are happening, but I can confirm that premiums are spiking, that the bid-ask spread is widening, that the SGE hiked margins, and that the inventory is draining. All of those data points are consistent with a severe supply shortage, and they're inconsistent with the everything is fine narrative. Let's talk about leverage for a second, because this is where things get really dangerous for anyone holding paper positions. The SGE's 20% margin requirement means you need to post $20 in cash for every $100 of notional exposure. So if you're long silver at $80 per ounce and you're leveraged 5-to-1, your effective entry price doesn't matter as much as your margin cushion. If silver drops by more than 20% from wherever you entered, you're getting liquidated. But here's the flip side. If you're short silver, meaning you're betting the price will go down and silver moves up by more than $5 from wherever you entered, you're also getting liquidated. Think about what that means in the current environment. We're sitting at $80 right now. If we spike to 85, anyone who shorted above 80 with 5.1 leverage is completely wiped out. And if we spike to 90, anyone who shorted above 85 is wiped out. Each wave of margin calls and forced liquidations pushes the price higher, which triggers the next wave of margin calls, which pushes the price higher still. It's a reflexive loop, and it's exactly the kind of thing that causes prices to go vertical. And here's what really keeps me up at night. We don't know how many of those leveraged short positions are out there. We don't know how many hedge funds or proprietary trading desks or algorithmic strategies are betting on silver to decline. Assuming that the $84 high from December was the top and we're heading back down to 70 or 60 or wherever their models say we should go. If those positions are large enough and if they're forced to cover all at once, we could see a short squeeze that makes the price action we've seen so far look tame by comparison. So let me recap where we are so far, because I know I've thrown a lot of numbers at you. The export ban is real. January 1st, China locked down their silver supply. The inventory drain is accelerating. 17.3 tons gone on January 9th alone. The total stockpile is only 620 tons. The margin hikes are real. The SGE went to 20% on January 5th, which tells you they're worried about volatility and defaults. The delivery failures are rumored but not confirmed. If the 1 ton out of 64 story is true, we're already in crisis mode. And the price action is consistent with all of this. We're up 4.21% in a session, testing $80, and the bid-ask spread is widening. All of that points in one direction. The physical silver market is under extreme stress, and the paper price is increasingly disconnected from physical reality. Now, I know what the skeptics are going to say, because I've been in this market long enough to hear every counter-argument. So let me address the strongest objection head-on, because I think it's important to be intellectually honest about this. The strongest counter-argument is that this is just a logistical bottleneck. The January 1st export licensing change created a paperwork backlog. The silver is still there in the vaults or in transit or sitting at refineries, but the permits haven't been processed yet. It's a bureaucratic snarl, not a supply crisis. Give it a few weeks for the paperwork to catch up and everything will normalize. And look, I want to be fair to that argument because it's not completely crazy. China's bureaucracy is notorious for being slow and opaque and for creating bottlenecks. It's entirely possible that there are tons of silver sitting in warehouses right now that could be delivered, except for the fact that someone's export license hasn't been approved yet. But here's my rebuttal. If this were purely a paperwork problem, why did the SGE hike margins to 20%? Paperwork delays don't cause margin hikes. Counterparty risk causes margin hikes. Fear of default causes margin hikes. The exchanges worry that someone won't be able to meet their obligations, and that worry doesn't come from a stack of forms that haven't been rubber stamped yet. That worry comes from looking at the vault inventory and doing the math and realizing that the numbers do not add up. And if this were purely a paperwork problem, why is the price spiking? Paperwork delays don't cause 4% single session moves in a commodity that trades 24 hours a day. Supply shortages cause that. Fear causes that. The market is pricing in the expectation that physical silver is going to be harder to get, not that it's temporarily stuck in administrative limbo. Let me address another myth that I keep seeing pop up in the comments on other channels. The idea that silver is at an all-time high, so it must crash. First of all, we're not at an all-time high. The all-time high was in 1980 when silver hit $50 per ounce in nominal terms. We're at 80 right now, which is higher than 1980 in nominal terms. But if you adjust for inflation, 1980's $50 is worth about $180 today. So in real terms, in inflation-adjusted terms, we're not even halfway to the all-time high. But more importantly, the idea that prices are high, therefore they must fall, is just not how markets work. Prices are high because demand exceeds supply. Prices will stay high until either demand falls or supply increases or both. And right now, I don't see demand falling. The energy transition is accelerating, not slowing down. Electric vehicle adoption is accelerating. Solar installations are accelerating. Industrial demand for silver is structural, not cyclical. It's not going away because the price went up. And I don't see supply increasing fast enough to matter. Silver mining takes years. You can't just turn on a new mine because the price spiked. You have to find the deposit, get the permits, build the infrastructure, hire the workers, and start production. That's a 5 to 10 year timeline minimum. And even if every silver miner in the world went to maximum production tomorrow, it wouldn't be enough to fill the gap between what the world needs and what the world is producing. We've been running a structural deficit in silver for years now. The only reason prices stayed low for so long is because the above-ground inventories were large enough to make up the difference. But those inventories are being drawn down, and once they're gone, there's no buffer anymore. One more thing I want to point out because I think it's a tell. Look at the bid-ask spread. Right now we're at 79.88 bid, 802 ask. That's a 14-cent spread. In normal market conditions, that spread is 5 to 7 cents. Why is it widening? Because nobody wants to sell. Think about what that means. If you own physical silver right now, you're looking at the price. You're looking at the news about the SGE. You're looking at the export restrictions. And you're thinking, if I sell this, can I buy it back later at a reasonable price? And the answer is I don't know, and I'm not willing to take that risk. So you hold, and when everyone holds, the spread widens because there aren't enough sellers to match the buyers at the current price. That's not a sign of a market that's about to crash. That's a sign of a market where the people who own the physical asset think it's going to be worth more in the future, or at least that it's going to be harder to acquire in the future, and therefore they're not letting it go. So what happens next? Let's talk about the institutional reaction, because the SGE is not going to sit around and let this spiral out of control without doing something. The question is what they do and when they do it. The most likely move, in my opinion, is that they invoke emergency cash settlement. There's a rule in the SGE rulebook, I believe it's Rule 589, though I'd have to double check the exact number that allows the exchange to force cash settlement on physical delivery contracts in the event of a supply emergency. They declare force majeure. They convert all the outstanding delivery requests into cash and they buy themselves time. Now, if they do that, it's going to be framed as a temporary measure. They'll say something like, due to unforeseen logistical challenges related to the new export licensing framework, the Shanghai Gold Exchange is temporarily suspending physical deliveries and will cash settle all outstanding contracts at the prevailing spot price. We expect to resume normal operations within X days or weeks. They'll make it sound boring and procedural and like it's no big deal, but the market will know exactly what it means. It means the vaults are empty or close enough to empty that they can't risk letting people keep withdrawing metal. And once the market understands that the price is going to explode because everyone who is planning to take delivery through the SGE is now going to have to source their metal somewhere else, and there isn't anywhere else with that kind of volume. The other thing to watch for is a media blackout, or at least a media minimization.